Jenny Turner with Lovejoy Real Estate. Today I'm going to be talking with Stephen Bowdon at Academy Mortgage, just kind of about the market, what's going on, what we're seeing out there. Stephen, when you have clients say to you right now, I'm just going to wait. I'm going to wait for interest rates to come back down. I'm going to wait for prices to come back down. What are you hearing and how are you talking about that with your clients?
Yeah, so it's funny because for the last 5 years, people have said, I'm going to wait for the next crash, and I'm going to wait, and I'm going to wait, and I'm going to wait. So it's always funny because we say, well, look at what happened to the people that bought 5 years ago. Look where they're at today. Their values have doubled, things like that. With interest rates going up and also values going up quickly, one of the things I always tell people is, I had somebody the other day, what if I saved an extra $1,000 a month and waited 6 months? And my thing is always, can you save faster than the appreciation of the house that you're buying, right? So I would have
For most people, they can't.
Yeah.
Right? Most people can't.
So I'd have you run that scenario, right? Like, hey, what would this house appreciate? And it's whatever the percentage is now.
I mean, 15.8 for 2021. I don't think we're going to see that big of appreciation in 2022. I'm hearing 5, 6, 8, 10. I mean, nobody knows, right? Nobody really actually knows. But let's say it's 5%. People can't save even at 5%, which is a conservative number.
Yeah.
People can't get ahead of that in 6 months.
No, not at all. So I would say if you're not out saving the appreciation on the homes, you're actually going backwards. So I think that's a big, it resonates with people, right?
We've been talking a lot with our clients about getting in the market. Like maybe you're not getting in the market on your dream house. Maybe you're not getting in with what you really, really, really want, but jumping into the market so that you can start having that appreciation while you continue to save. So then 2, 3, 4 years, you can trade in and buy up, right? You can trade that smaller townhouse that you really didn't want a townhouse, but you could afford that today, and then you have some appreciation to launch you to the next one.
Yep. I always say that. I always just say it's a springboard to the next home. Get what you can now, stop the rates from going up, stop the payments from going up, and the values from going up, because the second you buy, that all stops.
Right.
And then, reevaluate, people get raises, their incomes go up, things like that. But yeah,
Rates have gone up a lot in the last couple of weeks, months, beginning of the year. And I know for me, right now we're at rate-wise kind of where I expected to be by the end of 2022, not March of 2022.
Yeah.
Did they go up faster than you thought?
Faster than anybody thought. So we always have forecasters, and they're just that, they forecast, but just like in Portland, they can never forecast the weather. So forecasting always happens kind of in the fall of the year before.
Okay.
So you had Fannie Mae, Freddie Mac, you had Realtor, you had Mortgage Bankers Association, they all did projections, and they projected that we would be, high 3s, low 2s by the end of 2022.
Okay. And we hit that by January 5th?
By the end of the first week in January, we hit into the 4s. And so right now, the reason and what's driving interest rates up is inflation. And then also accompanied with the mortgage-backed security purchases that the government was doing.
And they're not doing as much of that right now, right?
They're not doing as much mortgage-backed security purchases as they were. So it's a combination of that and inflation. And in the mortgage world, the investors that buy mortgage-backed securities don't like inflation. So when they see inflation, they want a higher return. Therefore, rates start creeping up.
Well, it's interesting because a lot of our clients don't come to me and say, Jenny, I want to pay $500,000 for a house, or I want to pay $550,000, or I want to pay $450,000. They come to me and say things like, I want my payment to be $2,000 a month, or I want my payment to be $3,000 a month. And so how does it, like if rates are 3.5 and now they're 4.5, that 1%, is there any rule of thumb of how much buying power that takes?
Yeah, so you lose about 10% in your buying power. So if you were buying
for every percentage?
Yep, for 1%. So if you were buying a $500,000 house and rates went up by 1%, to keep that same payment, you would now be buying a $450,000 house to keep that same exact payment. So you lose about $50,000 for, in that specific scenario, 10%. So it's a lot, but we've been gradually creeping up starting last fall into the high 3s. Now we're in the 4s. And so what we do to combat that is client, what's your comfort zone? Where are you comfortable? And then I'm running live scenarios on properties as they're looking at them so that whatever that rate is for that day. The worst thing you could do is get an approval letter, sit on it for 6 months,
right,
and then not have somebody running scenarios for you, because when they get their documents, they're gonna be like, whoa, this is way different. So being active with the clients.
And you think about it, buyers' buying power is going down on a monthly payment, but prices are still going up. Right? The market's crazy.
It hasn't slowed people down.
It hasn't slowed people down. And I think it's interesting because we will see, at least I expect that we'll see, some of our buyers will no longer be buyers, because those buyers that just barely qualified, just barely made it at 3.5%, no longer really qualify at 4.5%.
Correct. Yep.
Right?
So what it did is it kind of took out the bottom of the people at the bottom of the price points.
The other thing that I think will be interesting as we move through this is I think it will also really affect our higher end properties. Because you take a bunch of people who have 2.8% 30-year fixed on their loans, and if I want to sell my house and I'm going to go buy a new house, and now I'm going to have a 4.5% 30-year fixed, I better really want to move to go from 2.8 to 4.5, right?
Yep. So I think a few years from now, right, because there's a cycle, right? People sell, and you probably know more than me, but over 3, 4, 5, 6 years, and they might not want to sell in year 4 or 5 because of their 2-point-something interest rate. So that could affect inventory years from now.
I think it'll also be, people will get more creative, right? Like we're buying a rental property, and I didn't like the rate because rental property, investment property rates are up. Fannie Mae, Freddie Mac are dinging you more than they used to ding you. And so we're going to take it off of our equity line because my equity line's 3%, and the rate I was quoted for the rental property is 4.875, which, I mean, I have good credit. That's like, that was a good rate for a rental property, but I can tie it off my equity line.
I think we'll see a lot of people. So a lot of people have built a lot of wealth through real estate, which is why we do it, right? So they built a lot of wealth through real estate recently. And what I see a lot of people doing is consolidation. Like I have a client right now, we're paying off all of their debt, literally everything. All they're going to have is just their mortgage. And in that case, yes, their rate's going up, but they're replacing high interest debts. And so they're doing debt consolidation. So I feel like there's going to be a lot of people using their equity for things like buying second homes, buying, rental properties, debt consolidation. So I think you're going to see a lot of that in the next few years because over the last 5 years, people have built a ton of wealth through their real estate. Well,
and you take like Ron and Yvonne, they could take the extra money from the sale of their house and use it towards their purchase, but they're choosing to use it to pay down some debt. And so it's just making different choices. And I think, especially coming out of a pandemic, people are a little bit more conscientious about that. They're paying a little bit more attention to what do they have out there, what are their responsibilities, what are their liabilities.
No, totally.
One of the things that I always get asked right now is about a bubble. Like, is it a bubble? Is it going to pop? Is it going to burst? And right now, Charles and I are buying a rental. Like, we close the end of March. So obviously, I don't think it's a bubble. I do think it's always a good time to buy investment property. What are you seeing from the financial side of that, though, with rates? And on your side, do you think it's a good time for investors to buy? Do you see those rates coming back down for them?
Yeah, I mean, from a rate standpoint, rates are risk-based. So primary residence, just imagine you have a consumer, and we look at everything in a risk standpoint. So foreclosure. Well, if let's just say that person goes through really hard financial hardship and they own a house and a rental property, what are they going to let go first? They're going to let the rental property go first. So that's why those carry higher interest rates, because they carry a higher risk for the banks. They've always had a higher rate than conventional loan, and that's because of that. In terms of if it's good or bad, it's all depends on the client. And so I always tell people, in certain markets, it's not good to be a flipper, right? So when you're thinking invest, some people think short-term and some people think long-term rental. Long-term rental is always a win, just like long-term in your 401k. Short-term is like when you're flipping things and you're in a volatile market, you could get burned. So I think it depends on the, I wouldn't say the flavor of their appetite for risk.
I talked to a client yesterday, and she has a really cute two bedroom, 1 bath in Sabin, close in, east side, a great little bungalow. They really want their next house, but they also want rental property. And I was saying to her, like, you should keep that house as a rental property. Like, live in it for another year or two. She has some stuff that she needs to clean up. She's got a new job. They have some debt they need to clean up. But I'm like, then keep that as a rental and go buy your next primary residence. And her concern was she might not have enough down payment or enough cash to be able to do that. Is there a way for her to access some of that equity in her rental to be able to then launch the next property?
Yes. So a lot of people are doing that. So I call it leapfrogging from house to house. So what they'll do is they'll move into the house, fix it up, it gets better equity, right? They build equity, they live in it for 5 or 6 years. But it does pencil as a rental, right? It can break even or maybe even make them a tiny bit of money, but then somebody else is paying that mortgage for them. That's ultimately the goal. So they can either go out and get a line of credit, or we can actually do a cash out mortgage, but it only goes to 80% of the value. So that's where a home equity line of credit sometimes can go to 90%, 95%, depending on the HELOC.
And that's a second mortgage on top of their first mortgage. So they would keep their original mortgage, but then they'd have a second mortgage on top, probably at a higher rate?
Yep, definitely. And what they do is they'll take that money, use it for a down payment on the next house. And most people don't realize that when you're going to buy a new primary residence and it's your second home or third home or fourth home, they think you need 20% down. You only need 5%. As long as it's a conventional loan amount. So doing a 5% down payment you're really not having, and I think that's the big misconception with a lot of people is like, oh, well, we're going to go buy another house, but we got to have this big chunk of money because we're not first-time home buyers anymore. That's not the case. You can do 5% down as a second-time, third-time home buyer.
The other thing that I was talking to somebody and we were talking about recasting, where they want to buy their new house, they don't have a lot of money down to buy it until they sell their old house, but they want to get it bought first. And I was telling them that they could buy the new house, and then once we sell their first house, they could use that money to pay down their mortgage. Is that always true, or how does that work?
It is true. There are some programs out there that don't allow a recast, so you always want to talk to your lender on what program they're doing. But really, I get a lot of clients that do this. In this market, you'll get people that have owned their home for 20 years, and they have so much stuff.
Right.
And they're like, no, there's no way, we're moving. Like, but we don't want to be contingent, and we don't want to have to get rid of all of our stuff. So that whole thing. So we're like, okay, let's be competitive in this market. Let's not be contingent. Let's go ahead and we'll just come up with the money for the minimum 5% down, and then later do a refinance. That's what they normally come to me for. And I, as an honest broker, say, I don't want you to do a refinance. You're going to have to accrue all those costs again. What we can do is we can re-amortize your loan through a recast. And then by doing that, your payment will drop and you'll keep your same terms. So they keep their same rate, they keep everything.
Because they put like another $200,000 down on their house or whatever it is, whatever their proceeds were from the sale of their house.
Yep. And then what they do is they maintain their rate. Nothing actually changes. The recast does cost money, so the lender has to go in, re-amortize, put a new amortization schedule, re-record that. So it could cost $1,000 or less, which is way cheaper than a refinance. But that's a really viable option. A lot of people that are retiring or downsizing, or there's 100 different reasons why you would do it. But the most important thing is getting their offer accepted, non-contingent, and that's why a lot of people do it that way.
Yeah, because I mean, it's impossible to be contingent right now. And I understand, like, I get the worry of, where am I going to go? I don't want to be homeless, right? I hear that all the time, Jenny, I don't be homeless. And we can almost always make that work. But it's nice when people have the option and the ability to just be able to buy without selling, get moved. Then we can take some time to freshen up the paint, do some stuff to the house. Because this market's so interesting. It's such an emotional market, not a data market, that I'm really finding for my sellers, the cuter we make their house, the clean, crisp, fresh paint, staging, whatever we can do to really make that house pop, they're making that back up in spades.
Oh yeah, yep, I've seen that a lot.
It's amazing.
It makes a lot of the clients will say that. We're gonna have a 2 or 3 month gap after we buy this next place. Get it fully out, polish it back up, we'll get more money.
I was with clients in North Portland last week, and her colors were beautiful. Every single wall had a different color, and it was gorgeous. And it looked good with her furniture, and it looked everything great. And she looked at me about halfway through the appointment, she's like, you're gonna make me paint, aren't you? And I'm like, I am.
Yeah.
And she's like, but I'm like, I know you love the colors. But that's the difference, right, between living there and staging it for sale. And she does love the colors, and I know the house they bought in North Portland, they moved across not very far, I know the first thing she did was gonna be painting all of it. But right now, as we speak, painters are there painting it all white. Because we can broaden that market for her, right? And it will pop and look bigger with bright light, nice, fresh, and she'll make more money.
Yeah, no, totally.
So, you know, Stephen, we've been so spoiled, right? Because rates have been so low now. I mean, I got licensed a long time ago, so I've watched them go up and down. I remember when I told my clients, oh my God, you have to lock. Rates are 6.99, they're never going lower. And then we got to like, what, 2.5 for some people? Now we're back up 4.25, just depending, right? Do you see them going back down, or what does your crystal ball tell us for the next 3 years? What's going to happen with rates?
So crystal balls are hard to find.
I know.
So you kind of have to understand where we came from for the last couple years to where we are. I always tell people we're in an environment of pre-pandemic rates, right? So pre-pandemic, we're in that low 4s. You might be able to kind of touch.
I don't even remember that. That was like so long ago.
Yeah, I know. Yes, right. And so those were historically low, right? So before the pandemic hit, historically low rates were low 4s, and you might be able to touch 3s here and there.
Okay.
Pandemic hit; those were artificial lows. The government came in and they said, "Oh my gosh, we have COVID. We don't want the rest of we can't have everything going to crap. We have to have we can't have the housing market go bad." And so they said, we're going to buy mortgage-backed securities. So the feds gave the Treasury permission to invest in mortgage-backed securities. So they're an investor. This isn't a bailout. They're actually buying mortgage bonds, getting a return. But they did it trillions, with a T, of dollars, buying down mortgage-backed securities to kind of keep that stable
keep it down
during
lower.
COVID. So I always tell people that was artificial lows. We had never hit those kind of rates on its own. Right? Because investors buy mortgage-backed securities, not
that many.
Not that much.
Right.
And so are they going to go down? Yeah, they could go down a little bit. They're going to do the seesaw that they've always done. I think pre-pandemic, before the government got involved, we were at a really good rates and everybody was very excited. I remember when rates hit 4.99 and people were like, oh my gosh, this is the craziest thing I've ever seen. And
Right,
so
like-
now we get spoiled and we have very short memories when it comes to interest rates. But what we have to remember is the rates in the 4s pre-pandemic were amazing. Low 4s, maybe touching a 3 was amazing. So I don't know if they'll go down again. It might take something pretty drastic for that to happen again.
I don't really want another pandemic.
I don't want another pandemic
Yep.
either. So, yeah.
I mean, and you think about it, like before our time, you hear the stories of like 1981 and rates were 17, 18, 19%, right? And buyers still need to buy houses, sellers still need to sell houses. Like, we don't all work off of what the rates are doing or what the market's doing. You know, people get married, people get divorced, people have triplets. So like, people still need to interact with real estate. It's just, what is that buying power? And we've gotten so spoiled. I feel like it's just hard to think about, gosh, rates might be in the 5s.
Yeah. So people focus sometimes too much on the rate. And so what they really need to focus on their comfort level. So what are you comfortable with paying each month? How much of a check
Right,
are
what
you
can you-
comfortable with writing at the end?
what can you afford?
And you know, and that's where you go out and you're trying to find a house that fits within that comfort zone. And it's going to be based on your interest rate. But your rate shouldn't be what's driving your entire search. Your comfort zone should be what's driving your search.
Right.
So that's the difference. Some people in the past few years, especially with technology, it's just rate. But what I've noticed and seen throughout my entire career is it doesn't matter what the rate is. You have a college student that just got their first job at Intel or Nike or OHSU or something like that. They're going to go buy their first house, regardless of what the rate is. And they're going to make sure that payment's comfortable for them, regardless of rate, right? So rate doesn't crash our market. It slows down refinances.
Of course.
But it doesn't, your families that are expanding, your people that are moving from other countries, all those things still happen.
Yep.
You can make housing very transactional, but at the end of the day, it's a home for somebody to live in.
Exactly.
And that's, you know, as long as it's in their comfort zone, that's what they're doing.
And that's part of that jumping into the market, right? Because right now, they need to buy something. Maybe they can't buy in Woodstock anymore, right? I have great clients and they're wonderful, fabulous, but like they really want to live in Woodstock, but their budget is really more like Gresham. Or maybe Milwaukee, maybe South Milwaukee, right? And they keep hoping, and we keep seeing houses come up on their market in their price point. You know, they really want to be under 515, so they've been looking like 450, 475. But in Woodstock or Southeast, those 450, 475s, they go for 550 right now, right? And they don't want to pay 550, but they haven't lost enough. They do believe us, they do trust us, but they're just really hoping that one of those won't go for that.
Yeah.
And so they keep making offers. You keep writing pre-approval letters.
Yeah.
We keep calling them on Tuesday and say, sorry, you didn't get your offer accepted. And they're gonna have to geographically go to a different area than they really want to be. Or they're gonna have to go to a townhouse, right? If location's ultimately key for them, they can't afford the single family detached little bungalow that they're dreaming about. They have to be willing to do a townhouse or something, right? Something has to give on that price, location, condition, and square footage.
Townhouses and condos. So a lot of people that were on the bottom, like we talked about, that were on the bottom with this rate pop, they no longer qualify for the single family residences. But you have townhouses and you have condos that are still fairly affordable in Portland. You can find them here and there. HOAs you have to watch out for. But you know, that is something that you can pivot to for sure.
And I would certainly rather a buyer buy a townhouse or buy a condo than stay being a rental. You know, I was looking at a rental building for one of my employees today. And like the lady was like, yeah, it's a 1 bedroom, 700 square feet. It's 700 square feet, 1 bedroom, $18.95 a month. And she showed me the like terrace on the roof and the game room and the little like, I'm like, $2,000 a month almost for a 1 bedroom apartment. I would way rather that buyer buy a townhouse or buy a condo, get some equity, and then launch in 3 years.
Yeah, build their equity. And here's the thing about equity, right? So you start out and say you have just a little bit down, and here's your purchase price, and here's your loan. Well, your value is doing this, but at the same time, your balance is doing this, right? So you're going in two different directions. When you're renting, 100% of your money just disappears. And I'll get people, and I always say, you're shifting your savings into a different form of savings. It's your equity. So when you pay rent of $2,000 a month, it disappears. When you pay a mortgage of $2,000 a month, a big chunk of that is going away as if it was a savings account. It's a different form of savings. And then in addition to that, you get the tax benefits, the tax write-offs of the taxes and the homeowner, the interest. So, but yeah.
The only other comment I have with that, which is interesting, is that like some of our buyers who barely qualify, they forget to take into account there are other costs of owning, right? Like it's not just rent of $2,000 versus mortgage of $2,000, because the furnace might die or the roof might leak, or like those other things happen too, right? So we need them to have some wiggle in their budget, and it works okay if you buy today and then your income continues to go up, because that gets easier and easier to afford over time, right? But I like it when our buyers buy a little bit conservatively and they aren't like stressing and maxing out their debt to income ratio, because those, like, life happens, right? The water heater dies.
Yep. And that's one of those reasons that we run those payment scenarios for people. What are you comfortable with paying? And sometimes if somebody's really pushing it, I'm like, are you sure?
Right.
Are you sure you want to do that? Because that can get a little scary, even for me doing their loan. I'm like, I don't know if we should be doing this for these people.
Right.
I mean, they're spending every dollar that they have. They're at the very max, like, you know, because we calculate things off of before tax income.
Right.
So I get to see what their after tax income is and their debts, and I'm like, ooh, are you sure? Gives you $100 a week to live on. It's the top ramen life again.
Right.
So
and
it's
who
not
wants
fun.
to be cash poor? Or who wants to be house poor? Like,
House poor, yeah.
That's just not any, I mean, that's stressful, right?
And I use that term a lot. You know, you don't want to be house poor.
Yeah.
Which is why when we're qualifying people, we don't even start with, oh, well, here's your max, or how much do you want to buy? We start with, what do you want your payment at?
Right.
How much money do you have to spend? What's comfortable for you? And then we're going to work backwards from there.
We talk a lot about that too. Is like, it's not what the bank says you can buy. It's what are you happy with? And I want them to talk to you or talk to a lender before we go out and look at houses, because if I show them an amazing property and they're like, this is it, Jenny, I love it, and that payment's more than they want to spend, I didn't do them any service.
No.
Right? Like, I want to make sure I'm showing them properties that do really fit their budget, which is why I love it when you give them the payments ahead of time, right?
Yeah.
Like, hey, did you run that through? Because sometimes taxes being a little different really make a big difference on payment.
Huge difference.
You know, like you were talking, like our clients last week who went under contract, taxes were really high on that house.
Oh, yeah.
So their payment was a lot more than they expected, because what else they'd been looking at had a lot lower taxes. And they might be able to, after the fact, argue those taxes down a little bit. But in the short term, they've got to take it what it is. And those taxes are just high.
Yeah. Well, I have this thing. So, you know, you hear the word buyer's remorse, and I actually call it financial remorse. So most of the time when you see somebody and they get in a contract on a house, it's not because they didn't like the house. They liked the house. But this is for a scenario where, say, they just had like an online approval letter. They got this generic approval letter 3 months ago. They went and wrote an offer, and that lender said, reach out to me when you need an approval letter. You get the approval letter, they get to the house, they get their first set of documents, and they go, oh my gosh.
If they didn't have any idea what it was going to
more
cost.
a month, this is this much more. And I call it financial remorse. So a lot of times it's not really buyer's remorse, because most of my clients don't bail on properties after they've gone into them and gone into contract.
Because they know the costs ahead of time.
Yeah, other than inspection and things like that. But so I call it financial remorse, not buyer's remorse. And now that I've zeroed in and started saying that to people, it actually makes sense, because if you look at any deal that falls out, a lot of times it's if somebody that has been working with somebody that's been working with them actively to keep them within that comfort zone.
Well, it's education, right? They need to know what it's going to cost. They need to know all the fees and costs.
Yeah.
Like, it's not just what is your down payment, but it's also your closing costs. It's your prepaid interest, prepaid taxes, all those things kind of all lump into that too. So it's what's your cash to close, what that's going to look like, and then what's that payment going to be. And then we talk a lot about like the next level of like utilities. Like, if you've been renting an apartment, maybe you're not used to paying your own water and sewer and garbage and all those other things that come around with it too, right? And so it's just making sure that whole financial picture is part of what they're looking for.
Yeah, and I always tell people when we're talking about that not only the payment but the out of pocket, I'm like, hey, you guys are gonna have to buy a lawnmower. You're gonna have to buy cleaning supplies. Guaranteed, you're gonna want to paint your first week. So we don't want to drain you down to $0 in your account when you buy, because there are a lot of expenses.
Totally. Yep. I usually have to buy a new shower curtain. Same idea, right? Like, yep. You know, sometimes, Stephen, I get asked, like, is it worth it, right? And I think back in my world, you know, I was just in Vegas at a conference and somebody was talking about, one of the speakers said to this big group of realtors, is it a buyer's market or is it a seller's market? And we all kind of looked at him like he was stupid, and we're like, it's a seller's market, obviously. And he's like, it's not, it's a buyer's market. He's like, because your buyer who bought 6 months ago is so happy they bought 6 months ago. And your buyer who bought a year ago is so happy they bought. And your buyers today should freaking buy a house. Yeah. Because they're going to be more expensive tomorrow, right? There's a funny little meme that goes around that shows a guy showing a house to a couple, and they're walking out of the house, and the caption says, the wife says, I like this house, but I'd like to see something more expensive. And the realtor says, no problem, I'll show you this house tomorrow. Because like everyday house prices are going up, right? Is it a good time to buy? Like, do you think should people jump on it and buy now if they don't own a house? What is your opinion on that?
I think so, absolutely. I mean, you build wealth through real estate. And, you know, people always say, well, when is it going to crash? When is it going to crash? And I always say, well, it'll plateau at some point. And what we're talking about is that mass appreciation, right?
Right.
So we're not talking about, and I've talked about, you start here with your purchase price, and then you've got your loan. Your loan's always doing this.
Yep.
So even if this one, the value isn't going crazy, you're still doing this. You're still building wealth through real estate. And so that's always a good thing. And it also goes down to, are you short-term person or are you long-term person? Right. But I absolutely think that, I always call it ripping the Band-Aid in a market like this, where as soon as you buy it stops that from going up like that.
Right.
But people always ask, oh, well, is it going to crash? Well, we all know that's not going to happen. We did horrible loans to people back in the early 2000s. Yep. And
it's hard to get a loan today. I mean, there's loans out there, but you have to T's are crossed and I's are dotted and
we do everything but blood samples now. So we know that everybody's going to get a loan that deserves to get a loan.
Yep.
And so we're not going to have these mass foreclosures like we had before. So there will be no crash. And then people say, okay, well, what the market? The market's going to, okay, it might cool down.
Right.
I mean, like you said, there's a 15% appreciation right now.
Right. And we can't, that's not sustainable.
That might plateau. But who cares if it plateaus? Because guess what? It'll do this at first, and we don't know how long that's going to last, but it'll do that, and then it might plateau.
Yep.
But guess what? You're still paying your balance down every month. You're still building wealth through real estate.
Well, and you're locking in your cost, right? Like rent goes up every month. I know in our rentals, one of the things we're getting ready to do is raise the rent a little bit because I have to raise the rent a little bit because my taxes went up, my other stuff went up.
Yeah.
But when you're a renter, you don't get to lock that in, right? Like on my mortgage, I know that my mortgage is going to be the same with a little variation for taxes and insurance for the next 30 years.
Yeah.
And so even though everything else, my God, gas prices, everything else is going up right now, but at least my housing cost is fixed, right?
100%.
And for a renter, your housing price isn't fixed.
Yeah, no. And you're not stashing any money that way.
I really want to go back in time when because sometimes you talk to people who are older and they're like, I paid $32,000 for this house, right? Even my husband's parents' house, they put it $134,000 for it. And now it's worth, I don't know, 1.2 million or something, right?
Yeah.
I can't imagine looking back, but at some point people are going to look back and be like, in 2022, I only paid $550 for that house. Whereas right now we're like, oh my God, it's so expensive.
Yeah.
It's just that different point of reference.
And then building the generational wealth, right? There's a lot of people that are buying as first-time buyers as the first person in their family to ever buy.
Right.
And, you do that and you start leapfrogging from house to house, right? Because your average first-time home buyer, this is their first house.
Yep.
It's also, they're all probably at their first or second job. Yep. So ultimately, people want to get raises and they want to do those things, but they can do that, stop the house prices from going up on them, build that wealth, right?
Right.
And then leapfrog into the next house.
It's always my favorite things. We just had when Nicole just sold a house to a couple. They were the first people in their family to own a house in 3 generations.
Yeah.
And it wasn't a very nice house. It was a starter house. It was a leapfrog house. It was something that they could put some sweat equity into. But when we gave them keys, the entire family, multiple generation were there cheering this young couple on. And that's the fun part, right? It's that you did it. You can change your family tree. You can be a homeowner. You can go through and do it. I had clients buying Kaiser last summer, and it was a VA loan, which sometimes adds some complications. And in this particular case, the buyer's dad was the lender, so we had some complications because dad thought he knew how it was and wasn't really in touch with what the market is right now. And I finally said at one point to the dad, I'm like, they don't have to buy this house, but buying this house changes their family tree. Because if they don't buy this house, they're not going to be able to afford, they just barely could qualify, right? In VA, as you know, it's hard to get an offer accepted. And I'm like, this changes their legacy. Yeah. And dad had rental property, so dad got it. But I'm like, this young couple needs to be a homeowner. Yeah. Let's make this happen. Yeah. And in the end, they got keys and we made it happen. But I'm like, but ultimately they have to want it, right? We can't want it more than they want it.
Yeah, no, definitely. And I always say it's like the train's moving and you're not moving. You're standing there watching it. And at some point, that caboose is going to hit and you might miss the whole thing. And in a market where the values are going up like that, if you are a first-time home buyer and you are in the bottom spectrum, you just got to grab on and just get on there. And, I think a lot of people overthink it. They need the 4 bedrooms and they need the fancy view or they need, the champagne taste on the beer budget.
Yep.
And you can't do that going in. And a lot of people have that.
And sometimes I say that to the clients, right? Yeah. I know this is what you want, but you're not there yet. Yeah. This is where you are. Embrace it, be there, own it. Yep. Figure out what's the most important, right? Okay, a yard's really important to you. Great, let's find a townhouse with a yard. Yeah. You don't need to have that single family detached house because you're just not there yet. But that buyer will be there in 2 or 3 years, right? Like I mean, right now, especially with the crazy appreciation, I have a couple buyers, well, they're sellers now, who bought 2 or 3 years ago from me, and they have enough equity to launch easily into their next property. But they need to get the old house sold first, and that's kind of scary. And we have to talk a lot about like timing and all that stuff because they don't qualify to buy 2, to own 2. But they can buy the acreage, the small parcel, the little more space, a little more privacy that they really wanted 3 years ago, but they couldn't afford 3 years ago.
Yeah.
And now, between a little more income and lots of equity, they can do it.
Yeah, yeah. And a lot of the first-time home buyers are putting 3 to 5% down, but by the time they're selling, they've got 20, 25% equity.
Totally.
Because it's doing those two things, right? Value's going up, balance is going down, and I see that a lot. But one thing that's funny is we'll get people that own a house that have, say, a $2,000 payment, and they want to buy a house that's bigger and nicer, and they still want a $2,000 payment. Well, it doesn't quite work like that.
Right.
It does give them a huge start because when you have a 3 to 5% down loan, you have mortgage insurance, quite a bit of it.
Right.
So on the next house, instead of doing 3% down, you might be doing 10 or 15% down.
Which lowers the mortgage insurance.
Which will lower that mortgage insurance and lower that payment. So it really does help jumping from one to the next. Yes, your payment's going to go up though.
Yeah.
A lot of people think that's not going to happen.
But what's interesting is I actually find for clients, like sometimes I have the opposite problem happen where somebody stayed in a house for a really long time. And so they've been in that like 550, 600, 650 house for 12 or 13 years. And now they can afford the $1.2 million house. But it's such a big jump that they really struggle with it. Where they'd really be better emotionally, like if they would have like sold at 5, bought at 7, sold at 7, bought at 9, and creeped their way up.
Yeah.
Like sometimes that big jump is even scarier for people, right? So it's such an interesting, like there's no right or wrong, right? It's just figuring out what works for you, what works for your family, and how to have that investment.
Yeah. And I always say there's no two people the same on their comfort level. You might have somebody that like is a total homebody, doesn't go out to eat, doesn't leave the house. Right. They're cool with a higher mortgage payment.
Right.
Somebody else who likes to travel and go out to dinner all the time, things like that. They were cool. So people always ask
sometimes
me, what's
those
your rule of
people
thumb? Yeah.
are married to each other.
Yes.
Right?
I know, that's the worst. But people say, what's your rule of thumb for like how much of a mortgage should have? Is it a third? And you go online, you follow all sorts of articles on it. And I'm like, it depends on you.
Right.
Every single person's going to be a little bit different.
Right. Nope, absolutely. Yeah, I'm a much more aggressive in my investment than Charles is. Yeah. And so we clash on that a little bit sometimes, right? And it's good we balance each other out. And I think that's nice when you there is a little bit of balancing that out. Because it's hard to know the right thing.
Yeah, totally.
Okay, so Stephen, here's my question. More and more I'm getting clients asking me about buying a house with Bitcoin, cryptocurrency. Can I come to you and say, hey, all my money's in crypto, can I buy a house? Like, does that work?
As long as it goes from the crypto into the banking system, then I can use money that's in the banking system.
So we can track it through, like it's okay if it's crypto as long as it gets translated into dollars.
Correct.
Got it.
Yeah.
Did you know the first house just sold on the blockchain? Just happened, Florida maybe? I've got to learn more. Like, I'm really curious about this because I don't know a lot about this.
I don't either. Yeah.
And we're getting more and more. I was at a conference in Vegas last week and they were talking about it, and the CEO or CFO of Proppy was there talking to us. And like I said to Charles at one point, like it's like she's speaking French. And Charles said, I know more French than I know about this. And so it's something that we're working on learning about right now. Because like saying like the first household on the blockchain, like I know kind of sort of what that means, but we're having to really work on educating ourselves because I definitely have clients out there asking me questions about it. We came back from that conference and Charles bought some kind of crypto. I don't even know what we own. And it's a small percentage. And he's been watching it and it's really volatile, right? And of course, like when we bought it, it went way down right after we bought it. So I'm like, damn it, we timed it wrong. But that stuff's a long game, right? You can't do that on the short game. And it has to be like, because it's so volatile, it has to be a small percentage of your world, right? Yeah. Like it can't be, if I lose all of that, it can't devastate me.
Yeah. If I was an investor, I would have a portion of it, just like anybody diversifies their portfolio, right? Yeah. But from a lending standpoint, we can use money, but it has to be in the banking system.
Right.
So you can't just say, oh, hey, I'm transferring money from crypto to escrow. It needs to go through the banking system, get into a bank.
Well, and if you think about how volatile it is, maybe they have enough of their cash to close on Thursday, but maybe on the following Monday when it's time to pull it out, they don't have enough cash to close, right? Mm-hmm. So you have to be careful about that too.
Yeah, definitely.
Yeah, it's something, we're definitely, like both of us are gonna have to get more educated around it.
Totally.
Because that is the way it's going and that is the world, and we have to understand it.
Yeah.
Jenny Turner with Lovejoy Real Estate. Stephen, thank you so much for talking to us today. We really appreciate it. If you wanna hear more, learn more, DM us, follow us on social, reach out, we'd love to help.
Thank you for having me here today, Jenny. I'm Stephen Bowdon with Academy Mortgage. If any of you have any questions, feel free to reach out.